In the shadows of the digital world, a new form of currency was born. It was called Bitcoin. The year was 2008, and the global financial system was in turmoil. Amidst this chaos, a mysterious figure named Satoshi Nakamoto published a white paper. This document described a peer-to-peer electronic cash system known as Bitcoin. No one knew who Satoshi was. Was it a single person or a group of people? The identity remains a mystery to this day. Bitcoin was designed to be decentralized. This meant no central authority would control it. Instead, it relied on a network of users to validate transactions. Little did they know, this was the beginning of a revolution. Satoshi Nakamoto didn't just write a white paper, he also created the first Bitcoin software. On January 3, 2009, Satoshi mined the first block of the Bitcoin blockchain. This block is known as the Genesis block. The Genesis block contained a hidden message. The Times 03 Jan 2009 Chancellor on brink of second bailout for banks. This message highlighted the failures of the traditional banking system. In the early days, Bitcoin was worth almost nothing. It was a curiosity, a project for tech enthusiasts and libertarians. But slowly, more people began to take notice. Forums and online communities sprang up where people discussed the potential of this new currency. It was a small but significant step towards mainstream acceptance. The first real-world transaction using Bitcoin occurred in 2010. A programmer named Laszlo Hanyecz offered to pay 10,000 Bitcoins for 2 pizzas. Another Bitcoin enthusiast accepted the offer. This transaction is now famous and is celebrated annually as Bitcoin Pizza Day. At the time, 10,000 Bitcoins were worth about $41. Today, they would be worth millions. This event demonstrated that Bitcoin could be used as a medium of exchange. Bitcoin exchanges were established, allowing people to buy and sell Bitcoins for traditional currencies. As Bitcoin gained traction, it caught the attention of investors and speculators. The price of Bitcoin began to rise. This attracted more people to the network, creating a positive feedback loop. Governments and financial institutions began to take notice of Bitcoin. Bitcoin was here to stay, and it was only going to grow from here. Bitcoin was the first cryptocurrency, but it wasn't the last. As Bitcoin gained popularity, other developers saw opportunities to improve upon it. They created new cryptocurrencies, known as altcoins. One of the first and most successful altcoins was Litecoin. Created by Charlie Lee in 2011, Litecoin aimed to be the silver to Bitcoin's gold. Another significant altcoin was Ethereum, created by Vitalik Buterin in 2015. Ethereum introduced the concept of smart contracts. This opened up a whole new world of possibilities for decentralized applications, or dApps. The rise of altcoins brought diversity to the cryptocurrency market. This diversity helped to drive innovation and brought more people into the crypto space. The year 2017 was a landmark year for cryptocurrencies. Bitcoin's price skyrocketed from around $1,000 at the beginning of the year to nearly $20,000 by December. The boom wasn't limited to Bitcoin. Many altcoins also saw massive gains. Initial coin offerings, or ICOs, became a popular way for new projects to raise funds. However, the rapid rise in prices also led to speculation and hype. Many people invested in cryptocurrencies without fully understanding them. By early 2018, the bubble burst. Prices plummeted, and many investors lost significant amounts of money. Despite the crash, the 2017 boom had a lasting impact. It brought cryptocurrencies into the mainstream consciousness. As cryptocurrencies gained popularity, they also attracted the attention of regulators. Governments around the world had different reactions to this new form of money. Some embraced it, seeing it as an opportunity for innovation. Others were more cautious, concerned about potential risks. In the United States, the Securities and Exchange Commission began to crack down on fraudulent ICOs. In China, the government took a more aggressive stance, banning ICOs and shutting down local cryptocurrency exchanges. Despite the ban, many Chinese traders continued to use foreign exchanges to buy and sell cryptocurrencies. In Europe, the approach was more balanced. The European Union introduced regulations to prevent money laundering and terrorist financing through cryptocurrencies. Some countries, like Switzerland, became crypto-friendly hubs, attracting startups and investors from around the world. Media has played a crucial role in the rise of cryptocurrencies. Initially, the media's coverage was largely skeptical. Many articles focused on the association of Bitcoin with illegal activities. This negative portrayal created a perception that cryptocurrencies were mainly used for criminal purposes. However, as more legitimate use cases emerged, the media started to change its tone. By 2017, during the Great Crypto Boom, media coverage reached a fever pitch. News outlets around the world reported on the skyrocketing prices of Bitcoin and other cryptocurrencies. This brought a wave of new investors into the market. Sensationalist reporting contributed to the hype and speculation. When the bubble burst, many people who had invested without fully understanding the risks suffered significant losses. Decentralized finance, or DeFi, is one of the most exciting developments in the crypto space. DeFi refers to a new financial system built on blockchain technology. Unlike traditional finance, which relies on central institutions, DeFi operates through decentralized protocols and smart contracts. Ethereum has been at the forefront of the DeFi movement. Developers have created a wide range of DeFi applications, from decentralized exchanges or DEX to lending and borrowing platforms. These applications allow users to trade, lend, and borrow assets without the need for intermediaries. One of the key innovations in DeFi is the concept of yield farming. Yield farming involves providing liquidity to DeFi platforms in exchange for rewards. However, DeFi is not without its challenges. The rapid growth of DeFi has also attracted bad actors, resulting in significant losses for investors. Non-fungible tokens, or NFTs, have taken the world by storm. Unlike cryptocurrencies, which are fungible and can be exchanged on a one-to-one basis, NFTs are unique digital assets. Each NFT has a distinct value and cannot be replicated. The NFT craze began in earnest in 2020. Artists, musicians, and even celebrities started to create and sell NFTs. Some of these NFTs sold for millions of dollars. For example, a digital artwork by the artist Beeple sold for $69 million at a Christie's auction. NFTs are built on blockchain technology, which ensures their authenticity and provenance. However, the NFT market has also faced criticism. Some argue that the prices are inflated and driven by speculation rather than intrinsic value. Cryptocurrencies have come a long way since the early days of Bitcoin. Today, they are becoming increasingly integrated into the mainstream financial system. Major companies such as Tesla and PayPal have started to accept Bitcoin as a form of payment. Institutional investors are also getting involved. Companies like MicroStrategy and Square have invested billions of dollars in Bitcoin. This institutional interest has helped to legitimize cryptocurrencies and has contributed to their growing acceptance. Even traditional banks are starting to offer crypto-related services to their clients. In addition to financial applications, blockchain technology is being used in other areas. For example, supply chain management, healthcare, and voting systems are all fields where blockchain can provide transparency and security. Despite these advancements, there are still challenges to overcome. The future of cryptocurrency is a topic of much speculation. Some believe that cryptocurrencies will eventually replace traditional money. They argue that the benefits of decentralization, transparency, and security are too significant to ignore. Others are more cautious, pointing out the challenges and risks involved. One potential future scenario is the widespread adoption of central bank digital currencies, or CBDCs. These are digital versions of national currencies issued and controlled by central banks. Another possibility is the continued growth of decentralized finance. DeFi has the potential to revolutionize the financial system, making it more inclusive and efficient. Finally, the integration of cryptocurrencies into everyday life is likely to continue. Whatever the future holds, it is clear that cryptocurrencies have already made a significant impact and will continue to shape the world of finance.